Hi everyone, my name is Drew Norton and I'm a second-year law student here at Colorado Law. I also serve as Vice President of the Silicon Flatiron Student Group and incoming Executive Editor and Symposium Editor of the Colorado Technology Law Journal. I'm excited to introduce our next panel, AI Boom or Bust, a fireside chat on lessons from the Telecom Bubble. Led by Phil Weiser, Colorado Attorney General and former Dean of Colorado Law, as well as founder of the Silicon Flatiron Center. We'll also be hearing from Larissa Herda, retired chairman and CEO of TW Telecom. She's currently an active member on the Bridge and Entrepreneurs Network Colorado Board. Finally, we'll also be joined by Seth Levine, co-founder and partner of Foundry, a venture capital firm based here in Boulder. We're excited to welcome them to Silicon Flatirons and hear their perspectives. Thank you.
Thank you for the wonderful introduction. Both Seth Levine and Larissa Herda are dear friends of mine, and when I was asked by Matt, what do you want to talk about that fits on the agenda and who do you want to talk about it with, this was my answer. You should know there are three bubbles that we're going to be talking about. Mostly the telecom bubble and the AI bubble. We'll also probably talk a little about what was known as the internet or .com bubble. For those who are the younger students, there was a time circa 1999 when if you put .com after the name of your company, it skyrocketed in valuation. So famously, pets.com, a lot of those companies literally and figuratively crashed and burned. But it's worth noting some of the companies, Amazon.com, ended up being extremely valuable. So the internet was real, but all the companies turned out to be not sustainable. The telecom bust is the underlying telecom infrastructure that was built, and it carried the internet traffic. And there's some reasons why that infrastructure, some would say, was overbuilt or not built on a sustainable economic foundation. A lot of those companies cratered. Much of the infrastructure remained in the hands of other companies. And so in some sense, the AI bubble may look more like the telecom because whether it's data centers or other physical infrastructure that's being invested in right now, the chances are high it will end up somewhere. But obviously that's one of the questions people are asking. And I think it's fair to say each of these bubbles have different properties and each of us have different levels of depth of knowledge on each of them. So I'm just going to let both Larissa and Seth start first, which is as you think about these three separate bubbles, and we'll talk more about what it means to have a bubble, anything you want to add to my description or any thoughts that you have as you reflect on each of them. Seth?
Well, first of all, I just want to, thanks for having me. I didn't know we were supposed to bring notes. Larissa's got like a bunch of highlighted notes. Phil's got
wait. Let me just say.
Can I borrow a page?
When I've known Phil. Phil asked me to speak when I first became a public. Actually, it was first. I wasn't even a public company CEO yet. Phil asked me to speak, or maybe I was. It was 1999 or
1999.
I became a CEO in 1998, and I had never spoken publicly in my life. I was a CEO. And he asked me to come and speak to the law school, and they were learning telecom law, which I didn't even know was a thing, actually. And they were learning what I was doing, and I was so like, it was the most amazing experience. And so I've known him for a long time. So when Phil asks me to do something, I usually say yes, and then I regret it later. So I regret it only because I had to really study and remember 25 years ago or 20 years ago what happened to us. It was such a traumatic time in my career, but it was also a pivotal time, and it was what led to my success as a CEO. So.
Well, let me ask that, because then you're getting to real area. Being the CEO of a company during a boom, which is like a sugar high, and then a bust, which is like things crashing down, that's intense. How was that experience?
It was one of the most difficult times of my life because to reel it back a little bit, I became a CEO under stress. The CEO quit. I went to work for Time Warner. Was really Time Warner Cable at the time to run sales for their company because they had invested about $150 million building fiber networks with their cable brethren, and they weren't bringing in any revenue. And I worked at a company that had just gotten bought by WorldCom, and I thought I was going to have a great career there. But I was recruited to run sales. I ran it for about a year. The CEO quit. They made me CEO, and my interview wasn't an interview. My response was, but I don't know this, I don't know that, I don't know this, I can't read a balance sheet, I have no business background, I'm just a salesperson. And they said, but you know this business, and oh, by the way, you have to go out in 3 weeks and raise $400 million of high yield debt in the market. So in June, I became CEO on my 40th birthday, and in July, I raised $400 million of high yield debt. And then we took the company public a year later. So lots of stories there for another day. But when everything, we ran the business to show growth. We created the strategy around the assets that we had, which fortunately were really good. Lots of fiber, we were going into buildings, but we really became a carrier's carrier. So when the internet busted, or when WorldCom went bankrupt, all hell broke loose. And they were a 14% customer of ours. I had 3,000 employees at that point. And WorldCom was a capital contagion event. The capital markets closed. We fortunately had money in the bank, but we couldn't support 3,000 employees anymore. We didn't know it was going to go on because most of our customers were going bankrupt. From an emotional standpoint, when we laid off 1,000 employees, on the employee call, I cried. And what was so interesting was that brought employees together, that even the employees that we laid off were sending me letters telling me they understood that I wasn't just doing it to make our numbers better, I was doing it because I cared. And it was a seminal moment for not just me as an executive to understand how to run, really what was important in business, but it also set the stage for the future of the culture of our company.
Seth, you're a venture capitalist who started your career working in some of these telecom companies, and you got through that experience. You're now watching this new moment. Obviously, you cannot be a VC and not thinking about AI. As you look at these bubbles, what are some of your reflections?
So first, let me just say that having been in the telecom industry at the same time Larissa was, everyone always looked up to Time Warner. Like it was, and when we were cutting these sort of weird reciprocal deals that like didn't really feel like they were the right things to do, I say we, meaning the companies that I work for, Time Warner was always seen as sort of the kind of the cleanest. And I think it's because you were a carrier's carrier and you benefited from having rights away from Time Warner, the parent company. But it's worth saying, right? We all looked up to TWT. I started my career in banking, and we raised a bunch of the high yield debt for it was before you were CEO of Time Warner, but for a bunch of these firms. And I remember adding up sort of all the market penetration numbers from all of these companies and thinking, well, there's like a 300% market here, and that's not going to work. But that was not my job. My job was to crunch numbers and give it to the higher ups at the time. So let's talk about the differences between these bubbles. I actually think all of these bubbles are quite different, and they were all caused by something sort of slightly different. And I think that they'll have different outcomes and different effects. And we'll talk later about whether bubbles are actually bad. And there's some reasons to think that bubble behavior is sort of how the U.S. innovation economy actually works and works most effectively.
And just to be clear, we had a railroad bubble in the U.S., right? So we've had bubbles as part of economic development, technological innovation. Almost every technology you could look at, there was some type of bubble behavior. So when we use the term here, we're using it, call it clinically, not pejoratively. The pejorative term, you may recall, there's this famous tulip bubble, right?
Absolutely. Tulips, oil, rail.
But sometimes they're not based on something that is about real economic and technological progress. Sometimes it's based on pure speculation. We're talking about it clinically. These are areas of the economy that are changing, but people get really excited, speculators speculate, and then we have a bubble.
I think that's a really important differentiation, right? If there's an underlying sort of ultimate rationale, but like economic rationale, and there was even for the internet, right? As we've
Amazon.com.
As we now experience. But by the way, Chewy, right? Like it's not, Pets.com famously failed. companies were spending way too much money on marketing. They didn't understand unit economics. Like all of those things were true back in the mid 90s, but also there are a lot of companies, Chewy is a good example, which was essentially is essentially doing what pets.com tried to do. So it's not that there wasn't ultimately a business rationale for it. It was that people got carried away with it, right? And that was that internet bubble, which was people saw an opportunity. The market just simply didn't develop as fast as people either thought or hoped it would. And it was a bit of a gold rush, right? And so everyone, another bubble, by the way, everyone was jumping into the .com. And I remember that if you're old enough like me to remember this, like all of a sudden the TV ads for companies, where it was like whatever, Acme, now it was acme.com, right? They were like, everyone was trying to get a little bit of that pixie dust. That might be going on a little bit in the AI. The telecom bubble was a demand bubble, right? It was a lack of demand bubble, right? It happened, the reason that all these telecom companies were doing these swap agreements and other sort of nefarious deals, some of which were technically legal at the time, even if they weren't appropriate. A bunch of them were not legal, right? Global Crossing comes to mind, a company where a bunch of people went to jail. Even locally, Quest did a bunch of deals that
all customers of ours.
I'm sure, yeah, and the Quest deal, Global Crossing did a bunch of deals where they did a bunch of swaps where no money changed hands, but both companies got to book revenue. That didn't sound right, and so that's why that didn't work. And in Quest's case, they were basically trying to hit revenue targets by essentially front loading their own say investment, if you will, into customers that were then buying from them, and the CEO of Quest went to jail for that. That was different behavior than some of the other things that we'll talk about that were going on there. But to me, that was like a demand bubble, right? There was not quite enough demand to satisfy the amount of fiber that had been built in the time frame that it needed to be purchased, and so that was what that was. AI, I think, is different. I think that the bubble, if you will, in AI is more around, or the challenge with AI is more around business model, right? There's obviously a huge amount of demand for AI services. Anthropic just upped their revenue forecast for next year. This is a company that didn't exist 6 years ago, and they're going to do, by their own measure, $80 billion in revenue next year. Sorry, this year, 2026. So there's clearly demand, but there's a business model challenge. OpenAI is obviously the revenue is a little bit lower, but it's in the same boat. Like they've been growing quickly from a top line basis, but the cost of providing that service is really, really, really high.
And there was some of that in telecom. And Larissa's point, you're raising money to make investments, but you're not making money year over year because you're spending so much money making investments. In order for that to continue, you have to keep being able to raise money on the promise you're eventually going to make enough money to pay it back. And if what's the phrase? If the music stops before you have a viable business, you go under.
Well, and bandwidth demand was growing, and the thesis was that it was going to be infinite, and to some degree it is. I mean, when you think about telecom industry, the thing that was good about the bubble and the bust is there's all this fiber infrastructure out there now that AI is now able to ride over, and it's created this innovation in business. And so there's bad things to it. There are a lot of people who lost a lot of money. It crushed a lot of businesses. It almost crushed ours. But we did a bunch of things that prevented that. And I think a lot of it was the discipline that we had. But pricing really fell. And I think that's one of the questions I would have about AI. What happened with us was that we would, sign up long customers on even a 1 year, a 3 year, or 5 year contract. And when they came up due, there was so much competition, especially in the carrier to carrier space. We didn't have a defensible market position. Nobody did. And so what we did after WorldCom went under and our 14% revenue customer was about to, cause us to go bankrupt, is we changed our business model. And we focused on diversifying our revenue stream. We built fiber into enterprise buildings, but we always maintained a business plan for every building we went into. We had a minimum revenue requirement so that we got a minimum return requirement so that we could pay back the infrastructure that we had spent millions and millions of dollars to put the whole network together. And you have to look at what's going on with AI and, applications, all that stuff, that's otherworldly to me. But they have an infrastructure investment that's very telecom-like, the data centers, the power requirements, the long-term leases. Capital is someday going to look at that and say, well, when are we going to get, when am I going to get paid back, right? And I think that's where I'm interested to understand better, where that's going to go, because it's an extraordinary amount of construction that's going on.
Unbelievable. So we actually talked earlier and we were like, let's not have this conversation in our pre-meeting because we probably are going to have like a discovery together. And I think part of what we talked about was like, we don't have all of the answers here.
Right.
I do have a perspective though, which is that like, yes, over a 25-year period, we managed to use up the bandwidth that was built, but it was over a much, much longer period of time.
Which really hurts returns, right?
Well, absolutely. And so I think to me, AI, and that's why I said there was a demand problem that ultimately fueled the bubble that was telecom, or maybe caused the bubble to crash or to burst. But I think it's slightly different in AI. Yes, it's telecom-like in the sense that the dollars are really high and there's a lot of infrastructure that needs to be built. But I actually think that the demand is outstripping supply. The problem there is more, to me, a fundamental sort of unit economic problem. Now, that problem also a little bit existed in the telecom world for sure. And kudos for you for actually understanding your unit economics. Because when I was a banker to telecom, I had this conversation with a lot of CFOs and CEOs who actually didn't understand their unit economics. And I did a bunch of analysis, including eventually for a company that I worked for, where I was trying to describe which products were actually cash flow positive and which ones weren't.
Well,
and people actually didn't care because they were just chasing revenue.
Right. And they were also, the theme from the analysts was asset accumulation. I remember it was a few months before I became CEO, Time Warner was trying to get rid of us because we were on their balance sheet and we were not strategic to them. They were happy to sell us. XO came in. XO was a competitive player back in those days to kick our tires. And this chief operating officer was taken on a tour by our operations guy who talked about cash flow. And my operations guy came to me in a panic after the meeting. He goes, I don't think it went well because he yelled at me and said, what are you worried about cash flow for? All we care about is putting the network out there, getting the network, put it out there. And so that was like, I went to Time Warner because they were making an offer. I said, Time Warner, do you really want them? Because it was their network too. Do you really want them to be owning your network with that philosophy of cash flow is not even a thought?
And a good sign that we were in a bubble in telecom is
Right.
that a lot of telecom companies were valued by fiber mile.
Right.
Right. So it's like how much fiber can you put in the ground? That's what you're getting valued by. Now the equivalent, which is not happening in AI, is if you were valued by the GPUs that you had, under contract or something like that. Right. And that's not how Anthropic opened.
How are they being valued?
Well, that I can't tell you.
Okay.
Well, let me go to
I can't figure it out.
Think of, and that's
well, I'll tell you, they're being valued in part on a prediction of how much of our future economy is transformed by AI. And so that means these technologies that tend to get sky high valuations, the premise is they're transformative in a way that will have huge economic implications. And I think as a general matter, I do think AI is going to have huge transformative implications. Whether that can justify the valuations, we can't go super deep there. But let me go to a point. Larissa raised it, Seth raised it. Circular deals. You heard that phrase. There's another concept, and I want to go back literally to the lecture that Larissa was talking about, which I'll call opportunistic, motivated behavior to generate what has the appearance of revenue that's not sustainable. That's a slightly broader term than circular deals. Circular deals are a form of opportunistic generation of revenue that's not sustainable. Some of you will remember this term, reciprocal compensation. That was literally the topic that Larissa joined to talk about and was impressed that law students were familiar with it. So Larissa, what was that reciprocal compensation issue and how is it a form of opportunistic revenue that was not sustainable?
So I think it goes into the category that in our industry, in the competitive telecom industry, there were different business plans. We were a fiber-based plan. We really liked mostly just using our own network, best margins, especially when we started selling to enterprise customers. We created a defensible market position, and we could have some price stability. There were companies out there who and they got better valuations, by the way, than we did for a long time, that used other people's facilities only. They may have had Lucent lend them a switch, and they had, that was a whole kind of funding of your customer base for Lucent, which they didn't account for properly, I guess. And a lot of these companies were called smart builds. So they didn't build fiber. They had the switches, and the goal was to put as much revenue as possible through it. And and I think this class, obviously, they were laughing at RecipConf, so they all know about it, which is so interesting to me. So they could make a lot of money by selling their services to the internet providers, who, when the services were dial-up and going through the switches, were just an enormous amount of traffic was going through these switches, and then the incumbents were having to pay them, and it was this kind of transient revenue that we didn't see as a good long-term strategy. At first, the incumbents actually tried to make us pay lots of dollars for it because they thought we were going to be a consumer business. And when I first came to work for the company was trying to get the lowest RecipConf rate. And I said, well, if they really want a high rate, you can give it to them, because we're not going to sell it to consumers. And if they were terminating on our network, we would have made a lot of money. But we didn't want to be in that business. There was a part of it when you have 5E switches that you were. But these companies were actually creating farms of traffic going, from these internet providers to these switches, and then charging the incumbent carriers and making a lot of money on it. And it convinced the marketplace that was actually a real business. And they didn't last very long, needless to say.
I'm just laughing because there was actually a version of this. This is back when I was still a banker. We were banking a company that was doing this. They were basically making money on these interexchange rates. And the CEO called all of us and said, I need to meet, but I need to meet in person. I don't want to have this conversation over the phone. And we were like, okay. So we will go into this conference room again. I'm like the most junior person in the room, so I'm just sitting there listening. And he explains to us, yeah, we make money through this interexchange rate, but I need to tell you, we've actually turned the switches off. So we're actually not routing the traffic back and forth. We're just routing it most efficiently, but we're saying we're routing it back and forth.
Oh my God, I didn't know that.
And so, to the credit of the bank that I work for, we dropped them as a client. But that is kind of how crazy that was.
But that literally takes us to the next point, and we've gotten at it through several directions. We talked about WorldCom. We talked about this behavior. Other firms engaged in similar fraud. And the question I wanted to ask you both, you look back at this telecom bust, one of the things that can happen in the boom side is people start doing things that are not real transactions. Quest was another company that engaged in, they called them swaps, that were not real. And you ended up booking, Seth will explain this, booking revenue today that wasn't real revenue. And you made yourself look like you were hitting numbers, but you were literally setting yourself up for a fall, because ultimately you'd have to admit there was no there. So what lessons of that boom period, Larissa, I want to give you the first chance. You clearly lived a lesson, which is stay disciplined, stay true, don't give in to the gimmicks. That is so much easier to say than to do.
It's hard to do when the analysts are telling you that you have a hole in your business plan because you are not doing this, and that's not a real business. And
where'd that come from?
I still think I have analyst reports that.
How did you stay strong? A lot of people be like, and by the way, the quote I gave is from the 2008 mortgage bust, which was the whole, if you haven't watched The Big Short, incredible movie, I believe Citicorp, which was financing these mortgage-backed securities, said, while the music's playing, you got to be on the dance floor. That was the opposite of Larissa. Larissa's like, I don't like this dance. I'm not getting on the floor.
Well, here's an example that we were told everybody was doing. And about 3 years, maybe 2 or 3 years before Enron fell, they came in and met with our CFO. And I cannot remember, these deals were so weird and complex, and Seth's probably more familiar with them than I am. They told us that everybody was doing something with their fiber that created this revenue, vision of revenue, I should say, over a 4-year period. And then my CFO said, well, but what are the CEOs? You said all these companies are doing it. And they said, yeah. He goes, well, what do the CEOs say or those companies say when you show them that it actually is a cliff vests in 4 years? And Enron's response was, well, they don't plan to be around in 4 years. So my CFO comes to me with this, and I said, oh my God, Enron's a customer of ours. And I stopped our sales force from selling to them anymore because I thought something was wrong in the company and that they were going to go bankrupt and we were going to be left holding the bag of their bad debt. And my salespeople were furious with me because why wouldn't you sell to Enron? They're such a big company and we're getting all this business. And I said no. So when Enron went under, it wasn't a problem for us. But then 2 years later, Enron came to us 6 months before they went bankrupt to try to sell us their entire long haul network for $750 million. And they would guarantee the revenue for 5 years to pay 100% of that off.
Can you say circular deals?
And I said, why would you do that? They needed the $750 million of cash. And so I said, well, sounds too good to be true. So no, we're not interested.
Just to be clear, the way those deals would work is like, I would agree to sell some dark fiber to you for whatever, $100. You would agree to sell it to me, some other dark fiber for $100, and we'd swap $100 and we each get to book that revenue, even though no money ended up changing hands.
Right.
That was the
and it didn't make any sense to us.
We actually,
but everybody did.
Another company I worked for Enron was an investor, and the way that they ended up being an investor was we actually did some dark fiber deals. Now ours were different than these. We actually just they basically gave us dark fiber and we gave them equity, so there was no revenue involved. But actually negotiated that stuff with Jeff Skilling across the table. Like 2 or 3 years before he went.
CFO from Enron ended up in jail. For those who don't know,
I think it does get to one of my main themes has always been discipline, and I think that and when the narrative and the optimism outruns capital discipline, that's when companies get in trouble. When you don't understand your unit economics, when you don't do the research to understand it, when you don't understand what the competitors are doing. And we had an idea. It was a bit of a surprise how bad the fraud was in our industry. And I think the regulators missed the boat on that. Sarbanes-Oxley, was a bit of an irritant, but was a good thing because it made people have to be honest. But to me, that was really weird that you had to be forced to be honest. But that was, that's ultimately what happened. And I really think because we really were very by the book, and I think we had just an incredibly ethical group of people. Our entire company was run that way. You could not do something like that in our company. And I don't know if that's happening in the,
All right, so let's go to this, because obviously Larissa was able to have a disciplined ethical culture. We could have a whole series of conversations. I hope some of you get involved in the Daniels ethics program here that the law school does, collaborating with Silicon Flatirons. How do we know on the current AI landscape which of the companies have a disciplined ethical culture versus those that are set up in ways that are not sustainable?
I heard some laughing, so I think we know.
How do we know?
No, I think it's really hard to say, and I think that's a little bit of what's going on with, like, people are very skeptical of OpenAI. I don't quite understand. I feel like there were a lot of companies back in the telecom bubble. Another sign that you're in a bubble is when your gross margin is negative and you claim you're going to make it up on higher volume somehow. I mean, it just doesn't make any sense. And I don't know what the number.
Everyone remember the Saturday Night Live skit about the bank, the change bank,
right?
You come in with $1, we give you 4 quarters. How do we make money? Volume.
And the difference was they would give you 5 quarters and then they'd make it up on volume. So I question sort of the gross margin for OpenAI. I don't, on the consumer side, I just don't know how that's working, and I think something's going to have to change. From what I can tell from looking at like Google, for example, and how they're leveraging AI, I think on the enterprise side there is profit to be made, and I think that's why Anthropic has become sort of such a darling, if you will, of for investors, and they keep raising more and more money. But it's Phil said this earlier, but I'll just put a finer point on it. If you're valued more than the sort of present value of your existing cash flows, then the only rationale for that is a sort of growth. And the more you're valued, the more massive that growth needs to be. And I think there's going to be a huge amount of pressure for all of these companies, given their valuations, multiples of revenue that are significant, to grow. And I think that creates environments where people can sometimes decide they're valued on fiber miles, so they want to put more fiber in the ground, and they're ignoring their unit economics, which is, I mean, from my perspective, having invested in, I don't know, hundreds of businesses, like that it works only if there's like a greater fool, right? It only works for a very short period of time if you get taken out. But if you're trying to actually build a business, then you need to care about your unit economics. And I think that my sense is that there are some companies, Anthropic would be one, that I think do care about unit economics and probably have good unit economics. I've interacted with Sam Altman, OpenAI, a little bit over the years. I don't know how much I trust him.
Well, this is an interesting question because we're going to watch it. There are people who said a statement with a little more of an edge than you just said about Bernie Ebbers. Bernie Ebbers was a darling of some Wall Street analysts, and there were people like Larissa, and if you want to read Dan Caruso's book, Dan explains it in his book, who said, I got to see him. I didn't trust him. You left WorldCom. Did you not trust that culture? Did you know it when you were in it?
Oh, I was only in it for about 2 months because they closed the deal at the end of '96, and I joined Time Warner in February or March of '97. Oh yeah, I mean, you should have seen the parties they had.
So Dan in his book talks about
by the way, I never went to one, but I heard about them. And it was after they had their first sales party, our employees at MFS were calling me and say, please take me, because, oh my gosh, they're doing it in the bushes. It was really quite amazing.
Dan in his book says he was asked to validate a transaction that was one of these sham type transactions we're talking about. And he said, no, I won't do it. And then he did that with like the CFO of WorldCom, who also ended up in jail. And that's why he's left the company. Last quick question, because I want to get some from the audience. Any lessons from that era around how law and regulation? I think, Larissa, you hit a big one, which is if there's fraud happening that there's not oversight for, it can get worse. So that's one lesson. The recip comp one is if you create regulatory induced opportunist behavior, that is a cause maybe to be worried about. Anything else that comes to mind?
You mean for
today's moment?
Today's moment.
What have you? What do you learn?
That
regulators today should know based on what happened back then.
I think they missed the systemic interactions between the businesses and the systemic risk associated with that.
Resilience of
and I think that they focused on things like interconnection and competition, which was fine. I don't think anyone could have imagined so many people would have committed so much fraud. I mean, it really is extraordinary when you think about it. The one regulatory thing that I would say that it's just really more my observation on the enormous amount of power that is being paid for by somebody, and it's not necessarily the companies that are building. They're paying for their new infrastructure, but when the grid has to be updated because of what they're doing, the ratepayers seem to be on the hook for that, and that feels wrong to me. There needs to be some if there's any regulation, there needs to be some thought put into why would the ratepayers have to fund that. So,
and I think that actually some of the AI companies are starting to recognize that they've got even if the regulatory agencies don't catch up, that they've got a PR problem. If they go into a community, open this great data center, and then everyone's
bill goes up,
prices double or whatever it is. The other I think real lesson is just like transparency and sunlight. It was really important.
Yes,
and I think what we were missing a little bit in the telecom bubble, less so in the internet bubble. I think that was just people being irrationally exuberant. But in the telecom bubble, you just did not know what was going on. It was kind of like it was the bubble, the mortgage bubble in 2008. People like literally were just not disclosing what they were doing.
Right.
And I think that now a bunch of the companies we're talking about in AI are private, but to the extent to which they're public, the disclosure of what's actually happening, there's a big debate now about how fast you can depreciate GPUs as an example. And the reason we're having the debate is because people actually have to put their depreciation schedules out there. So that's not a topic that's interesting to talk about, like should it be 5 years, 3 years, or 7? But at least we know what it is. And I think that's actually probably more important than anything else.
First question comes from a student. And we got lots of them here.
Thank you. So thanks for the primer on that. That was really interesting. One question I have about looking into AI now. I know you said GPU depreciation schedules aren't interesting, but on
they're
that
interesting to me, but
yeah.
I didn't think they'd be interesting to everyone.
If we compare to fiber and like that kind of infrastructure, like right now, obviously for data centers, energy, steel, all of those useful long-term assets, GPUs, lots of NVIDIA's valuation, lots of these companies, the technology advances so quickly that arguably maybe they're not that useful, or maybe they don't even work in 5 to 10 years. So was there a similar analog in telecom of an asset that maybe didn't last as long or was more kind of the time?
Actually, the fiber is still there. The equipment on either side is what determined the speed. So the technology changed. We actually were told by Cisco that we dragged the incumbents kicking and screaming into Ethernet because they didn't want to do Ethernet because it cannibalized their existing private line business. So there's that, it's the creative destruction of capitalism, but that's a good thing because Ethernet was a much better solution and much more scalable. But I not really. I mean, it was the problem with fiber, especially for the long haul providers, is if they happen to build it in the wrong place, it was kind of a sunk cost. We didn't have that issue because we were doing business plans for every single building we went into. So we really didn't, unless the company went out of business in a bit and we had expected to get revenue for the next 5 or 10 years and we didn't. I'm sure that happened, but I can't think of anything really.
Yeah, the only analogy I can think of is because when we're talking about depreciation schedule for GPUs, you're really talking about how profitable is a unit of revenue, right? Because if you have to depreciate over a shorter period of time, your costs go up. And the only thing I could think of that's similar to that is you could sometimes cut these sort of long-term lease deals, but you could depreciate. You could use it very quickly, but you'd actually depreciate the lease over a longer period of time. That may be the closest.
Yeah, and we didn't do those.
But it wasn't as prevalent, and it probably wasn't as big a deal.
One last question. I'm glad I don't have to pick.
So early on, Seth, you said obviously demand is really high. Look at how much revenue is being made by these AI companies. And then you spent the entire rest of the talk talking about different ways to juice your revenue as a company. So would you like to take a moment to speak to that?
Yeah, I guess I want to push on that for a second because I'm not sure I was talking about how AI companies should juice their revenue.
No. Let me rephrase this question. How do you know that the revenue stated by these AI companies is real, robust, sustainable, recurring revenue, not what, with the benefit of hindsight and Telecom Bus, we might call fake made-up revenue? Yeah. How do we know that?
I mean, my sense is, and again, I think the point that I was trying to make is that there was this demand problem in telecom. It took a long time for that demand to come up. But in the AI world, there's a ton of demand, right? And I'd start by just like looking around. Like every business in the world now is trying to figure out how to leverage AI. It's hard to tell with the private companies because obviously they're not disclosing. But if you go look at Google's disclosures, right, around how people are using Gemini, particularly in the enterprise, right, you're seeing significant demand from the enterprise. So I actually think that generally you think as technology matures, pricing goes down. I actually think we might end up with at least a blip of increased prices in AI because I think we're in some respects undercharging. And I think that's where OpenAI is going to have a problem because their revenue base is primarily a consumer revenue base. And I think there's some limits. Maybe that's why they're trying to rush to create new products because they recognize that based on their current economics, they're going to lose money, maybe on a gross profit basis for the rest of their lives. And so I think they're trying to layer on some new products on top of that so they can charge more, but consumers tend to be more sensitive to that. But from what I've seen in enterprise AI, there is, I don't want to say unlimited demand, but there's a massive amount of demand.
Do you think the applications could end up justifying these high valuations?
Well, and I wanted to go push on that because this is similar to the telecom and internet world, which is there are people who build infrastructure that enables applications. And so, for example, no question, Google, Meta have got huge value from the internet broadband world. but there are other companies that built enabling infrastructure that aren't around anymore. And so the question, I guess, back to you is, when you're saying there's all this value there, how do we know where in the value chain it is and which companies are going to be the ones to benefit from it?
I mean, interestingly, I'm going to say something that might seem, I don't know if it's going to seem controversial or not, but I mean, NVIDIA is one of the most valuable companies. Some days it's the most valuable company in the world. Traditionally, when you look at markets like the infrastructure players actually don't end up doing very well.
Right.
Right. So, I think that people are maybe discounting the efficiency, the changes in how these models actually work and run. And by the way, there's a difference between like sort of the inference and the training, and obviously NVIDIA chips do both. But when you're spending a lot of money on training for a period of time, at some point, like the models are trained mostly, right? You're incrementally training. You're not like training the entire model again. And I don't know that the markets have maybe absorbed sort of what trajectory that actually looks like. So, I mean, I don't think you make money by shorting NVIDIA, but I think if I were to pick a company that I was a little worried about, I would pick the infrastructure companies. I'm more bullish. Larissa said this, but I'll say it again. I'm more bullish on sort of the application layer, because I think that is more likely that's where the value ends up getting driven.
Well, and they're the ones that actually really benefited from the fiber build outs too. When you think about it, it was the companies that were buying the cheap capacity ended up doing better than the infrastructure.
And to be clear, when
we did okay, but
those companies are like Meta and
right,
and Instagram. Those are the companies that rode on the fiber networks and benefited from that.
It'll be interesting to watch. Can we thank our wonderful panelists?